All right, thank you very much for having the paper on the program, and also thanks everyone for sticking to the last paper. This is a joint work with Kelly Shue and Rick Townsend, and I'm very happy to share our research on categorical thinking about interest rates. So let me start with an accounting identity of long-term bond yield. End-period bond yield essentially is a sum of investors' expectation of a future average short rate, which we typically call expectations hypothesis component, and a term premium, which is the average excess return to be earned over the life of this bond. Well, sometimes we call this TP. If investors have rational expectations, this accounting identity would imply that the current long rate should already incorporate all the public information we collectively know about the future average short rate. And also, on the other hand, empirically, expected increase or expected changes in the short rate do not seem to predict the future changes in the long rate, future actual changes in the long rate. However, in this paper, we find that there's a widespread misconception that people seem to, at least in their mind, to regard that expected future movement in the short rate would actually predict the corresponding future actual movements in the long rate. And we think this is essentially a mistake. That is, people seem to collectively or lump the short and long-term interest rate into one category, and they apply overly simplified model to it. And we hypothesize that this is related to categorical thinking, a form of categorical thinking. So categorical thinking essentially is people often group similar objects into the same coarse category and apply the same model to all items within a category. So the commonly used categories that we use to reduce our cognitive loads include, for example, Asian Americans, stocks in the S&P 500, in like mutual funds or investments with different styles. However, empirical economics literature has found that categorical thinking often overlooks important differences within categories, leading to errors in judgments and decision making. So now turning back to interest rates, it is very natural to think about long rate and short rate in the same category because the financial media, I have a few examples on the left, often seem to essentially refer to them collectively as interest rates without differentiating between different maturities. Well, of course, the long rate and short rate share a lot of common characteristics. For example, it is true that the level of the short rate and long rate are highly positively correlated. And second, it's also true when the Fed announces a surprise change to the short rate, it will simultaneously affect the current short rate and current long rate, and often in the same direction. However, here's a kicker. It's not true that when the Fed announces a plan to gradually increase the short rate in the future would imply that the actual long rate will also move in the same direction and also in parallel. So this is basically categorical thinking because people fail to recognize the insight we have from the previous accounting identity, that is, the long rate should have already incorporated all the public information we collectively know about the expected future average short rate. So the financial media in the real world is basically abundant with bad categorical advice that suffer exactly the kind of bias that we highlight here. For example, here's one bad advice when interest rates or short rates are expected to rise. So this is almost from 3 years ago. Fox Business advocated that buyers should act ahead of a further increase, with experts in agreements that the mortgage rate will continue to rise as Fed continues to update its policy. Now is the time to lock in low mortgage interest rates. This is likely wrong because whatever future trajectory the Fed has already telegraphed should have already been incorporated into today's price. And also we have another bad categorical advice when the short rates are expected to fall. This is from Wall Street Journal from about a year ago when the Fed, after the Fed announced 3 planned cuts over the next year. So Wall Street Journal says, here I quote, "Unless you're really hard-pressed to buy a home, I would wait for the Fed to cut rates," which also is very likely to be a mistake because the long rate should have already gone up, reflecting all the information the market knows about the future anticipated cuts. So let me break down the intuition about categorical thinking about interest rates using a very simple illustrative figure. Let's consider 2 interest rates, the short rate I and the long rate Y. And typically, the yield curve is upward sloping, so Y is higher than I. Now suppose at time t, news arrives that the Fed will hike the interest rate multiple times next year. And also suppose in our example, this is the only piece of information, so the actual short rate in this case will increase gradually and precipitously. If investors have rational expectations, the long rate today should jump up immediately, reflecting all the information and level off. However, empirically, oftentimes we encounter this overshooting. And people seem to overreact, or investors seem to overreact to this piece of information, and subsequently the overreaction will revert, and this is the likely actual long rate trajectory featuring excess volatility. The crux of a categorical thinking about rates really lies in here how investors form their beliefs about the future long rate at time t. So if the investors exactly have rational expectation, their trajectory or expected trajectory for the future long rate should exactly follow the actual path. And also if the investors, they understand that the short rate or future expected short rate has already been incorporated in today's price, but they fail to recognize there's an empirical overshooting, so their forecasted trajectory should really be flat. However, if people are engaged in categorical thinking, they would think erroneously that the future long rate should really move in tandem with the expected future short rate. So their forecasted trajectory of the long rate would erroneously track the trajectory of the short rate. And this inevitably, or especially in anticipation of higher long-term rate in the future, inevitably will lead to an increase of a long-term bond supply because borrowers seeing or foreseeing a much higher longer-term rate in the future, they will rush to borrow today. On the other hand, people on the demand side, investors foreseeing a lower price or higher interest rate in the future, they would definitely want to sell off those long-term investments. So the two combined, higher supply and lower demand, would really create this overshooting today and a subsequent reversal. So it can also circle back to explain the excess volatility that we have seen in the first place. In theory, admittedly, so the term premium in the future could also move in the direction that make the short rate and the long rate move in parallel. However, we found that this actually not supported in the data. So expected change in the short rate actually negatively predicts the future realized long rate changes. Here we regress the next quarter's quarterly changes in the long rate across various different interest rates, the treasury yield, 10 years, 30 years, AAA, BAA corporate yield, and home mortgage rate. Regress that on the consensus forecast for the short rate over the next quarter. And we essentially uncover a very consistent negative relationship. If anything, at least it's not positive as the categorical thinking was suggesting. This, in a way, suggests that the long rate overreacts to expected changes in the short rate. It is consistent with the excess volatility in the long rate. But importantly, this indicates that movements in the term premium is unlikely to explain essentially the parallel movement between people's expected long rate and expected short rate in the future. So first we'll show you some evidence of categorical thinking and beliefs, starting with professional forecasters from the Blue Chip Financial Forecast. So Blue Chip Financial Forecast, or BCFF, is the longest consistently run surveys of professionals on interest rates. It's a monthly survey about 40 professional economists from the 82. Here we focus on the Fed funds rate as our benchmark short rate, and we focus on the home mortgage rate as our benchmark long rate because it has the longest availability. And throughout the talk, I'm going to adopt this particular notation where ET of X bar T plus NQ is the forecast of average daily interest rate X in the nth quarter in the future. The reason why it's defined this way is because this is exactly what the survey asks for. In the first regression, I'm going to explore the contemporaneous relationship between the expected changes in the long rate, which is we approximate using the home mortgage rate, and expected changes in the short rate, which we approximated using the Fed funds rate. So we look at the forecast changes in the next quarter, and across three different specifications, including a few like common debt market control variables, we uncover a very positive co-movement between the expected changes in long and expected changes in the short rate. And this coefficients is about 0.25 across different specifications. Well, I have already shown that the term premium is unlikely to explain this excessive co-movement, but what about the other term? What about the expectation hypothesis? So if the expectations hypothesis hold, essentially the left-hand side of the previous regression now equals 1/n of the expected changes in the short rate in periods ahead. So this is really a long horizon forecast of change. Based on this, it's highly possible to rationalize any beliefs about the changes in the long rate through the beliefs about essentially the short rate in the very long horizon. So we directly test this using the data. So we directly test whether observed the positive co-movement from the previous regression can be quantitatively justified by beliefs about short rate 10 years ahead, instead of driven by categorical thinking. So here we use this basically the long horizon forecast up to 10 years provided by the same survey, but at the semi-annual frequency, replacing the left-hand side with the expression we had before. On this page, we run this second regression, and specifically asking that if beta 4 approximate the large and positive co-movement that we had in the previous regression. And the result actually is pretty striking. If anything, beta 4 is very close or essentially zero, not only for the consensus 10 years ahead forecast for the short rate, but also for the top and bottom 10% of the long range forecast. This is in sharp contrast with essentially our baseline result. Here I rerun the regression using, because we're focused on 10 years, so I rerun the regression using 10-year treasury yields. And with this semi-annual sample, and we uncover a coefficient of 0.6, which is highly different and statistically different from all the coefficients we have on the left. So taking everything together, so the excess or the very strong co-movement that we have discovered in the first regression between expected changes of the short and expected changes of the long rates are unlikely to be driven by either the term premium or by people's expectation of a very long horizon short rates. And subsequently, this indicates that this co-movement is excessive. It's likely to be a mistake because expected increase in the short rate do not possibly predict the increase in the actual long rates. So here, this is slightly different from the regression I showed you before because we have replaced the term spread as the difference between home mortgage rate and Fed funds rate. And finally, if we put everything together, the forecast error of the long rates are highly predictable by today's expected increase or expected change in the short rate. And this is interesting, not only because this is a significant departure from rationality, because we can statistically significantly predict a future forecast error, but also interesting in the sense that predominantly in the literature of behavioral finance, with consensus forecasts, we usually uncover underreaction, but this clearly is the opposite. It's a very strong overreaction. Okay, so now let me move on to what I think is our strongest evidence. I'm going to show you that expected changes in long and short rate are going to exhibit matching shapes over the next few quarters. In this case, over the next 4 quarters. So let me essentially show you this in a graph. There's a lot to unpack, but just let me walk you through this slowly. So the lighter blue line is essentially the actual trajectory of the Fed funds rate, and the lighter red line is the actual trajectory of the home mortgage rate. And you see all this solid red and blue lines, each one of them is that branch off the realized time series. They are, respectively, the expect or consensus forecast of the Fed funds rate and also home mortgage rate over the next 4 quarters, which means at each point in time, there is a forecast or a series of forecasts for the short rates over the next 4 quarters and a series of forecasts for the long rates over the next 4 quarters. It is pretty apparent from this figure that long rate and short rate over the next 4 quarters seem to move in parallel. So let me just give you a few maybe highlights here. So for example, around mid-2000s and also mid-2010s when there's a liftoff of interest rates, So clearly, you see that people or forecasters were expecting an increased short rate over the next 4 quarters, but simultaneously, they were expecting the increase in the long rate over the same 4 quarters, almost in the same parallel fashion. It also works not only with a linear upward or downward sloping curve, it can also work with many different shapes. For example, I really wanted to highlight this to you, but I probably couldn't. So for example, around 2000, when the short rate was expected to take this very different N shape, it's going to expect to go up and then down in the next 4 quarters. Interestingly, the long rate were also expected to take a very similar N shape. And also we have another example, the short rate is taking a V shape, and the long rate similarly was also taking a V shape. That was around the 90s. So I can't keep doing this for the whole day, but you get a message. So the forecasted, or consensus forecasted paths of the short rate and long rate seem to move in tandem, at least over the next 4 quarters. So a lot of these forecasters are PhDs, so you would expect them to understand the relationship between long and short rate and the accounting identity. But even as we have shown in the paper, even some of the most prominent forecasters and economists seem to suffer something that's pretty similar. So here I have one particular prominent example from Gary Seminaro, and he is the chief economist of the FLE. He has an MBA from Sloan, a BizAc PhD from Harvard. He was once a professor at Wharton. He even tested before the Congress with Alan Greenspan. With all that credential in hand, well, his figure is probably even more exaggerated in the direction of categorical thinking. What's more, judging by the big difference between his curve and the subsequent realized value, we can tell clearly he has a lot of forecast errors. So to supplement all the visualization, we also have basically the same evidence in the regression setting. So here I regress the forecasted change of a long rate between 2 consecutive quarters in the future, which is the left-hand side, onto the forecasted change of the short rate between the same 2 consecutive quarters. So the timing of the left-hand side and the right-hand side is lined up. As we can see across different horizons from n equals 1 to 4 quarters, the coefficients are highly positively significant, and also they're stable, indicating that expected long rate and expected short rate seem to move in parallel. And also this, of course, similarly is a mistake because the forecasted change in the short rate over the 2 future consecutive quarters doesn't seem to predict the actual realized change between the long rates in the same quarters. Perhaps the most striking or interesting evidence is this figure. So in the first regression, we include all 4 changes in the short rate over the future 4 quarters onto the right-hand side. And as we can see here, the significance really pop up along the diagonal, indicating that the forecasted change in the long rate in quarter N is more likely or more related to forecasted changes in the short rate in the same quarter, more so than in all of the other quarters. Clearly, this is evidence consistent with categorical thinking. So we want to show that this code movement is excessive, it's wrong. It's even wrong when we compare that to some naive forecasts. For example, here we can take a hypothetical no change forecast for the long rate, for various of the long rates that we consider here, and also across different horizons, for 1 quarter ahead and also for 4 quarter ahead forecasts. So you probably wouldn't be too surprised to find out that once we evaluate the root mean square error of the actual consensus forecast of a long rate versus our hypothetical no change forecast, the no change forecast even did better than this, the actual forecast that essentially exhibited a lot of excess movement with the short rates. So in the paper, we'll also address quite a few alternative explanations, but for the interest of time, I will only briefly talk about them. We show that, first of all, the bank affiliate forecasters may have the incentive to forecast in increasing rates, and it's unlikely to essentially drive our result because we have a symmetric result with increase and decrease. And also we have the similar result if we only focus on forecasts made by people unaffiliated with any financial institutions. And I also, secondly, find that forecasters, they may have private information about the short rate, but it's unlikely to be driven to drive our result because we can also obtain similar results if we lag the signal, if we lag the reconcile by an additional month to make it publicly available. Third, it's unlikely to be driven by mistaken beliefs about long rate responding sluggishly to short rate news. We show that it's not really related to news itself. It's really related to expected changes. And a lot of times, this expected changes can really be telegraphed and known to the public well in advance. And finally, we also rule out the possibility that it's really driven by extrapolation. So next, we want to explore if the same categorical thinking mistake or bias also show up in households or in consumers. Here we use Fannie Mae's National Housing Survey, particularly focused on the question asking people about their future perspective of the home mortgage rate. So during the next 12 months, do you think home mortgage rate will go up, go down, or stay the same? So essentially taking the answers to this question, whether the home mortgage rate is going to go up, regressing this on consensus forecasts of whether over the same period of time, Fed funds rate or the short rate is likely to go up, we uncover a very positive and similarly significant coefficient. So literally it means when professional forecasters expect the short rate to increase in the next quarter. The reason why we use professional forecasts is because in the same survey, they only survey consumers about the long rates, the home mortgage rates. So when professional forecasts expect the short rate to increase in the next year, households were almost 20 percentage points more likely to expect the home mortgage rate also to increase over the same period of time. And also we can explore, given this much richer data set, we can also explore the heterogeneity among investors of this particular coefficient we just estimated across different levels of education and income. Interestingly, if you look at this figure across people with the coefficient across different education levels, there's an almost monotonic relationship. For people with graduate degrees, maybe these people are very similar to those professional forecasters. Their coefficients are not too distant from the professionals. But for people with a way less education, their coefficients are actually not too different from zero. We got a similar picture if we plot the coefficient along people with different incomes, and also similarly for people with a lot of income, they behave similarly to the professionals. For people with little income, so their coefficients are not so different. So here we seem to uncover a very unusual case where the particular bias we uncover here, the categorical thinking, do not seem to diminish with sophistication or education or income, but instead it actually goes in the opposite direction. And this certainly is different from much of the behavioral economics literature, which we think probably is well justified, because for people or the manifestation of this type of a categorical thinking bias really requires a certain level of sophistication. You really need to understand, have the information, have the signal, and also understand to some extent the relationship between the long and short. Before I move on, so let me comment briefly about the exact form of categorical thinking. This may differ actually across different groups that we're looking at here. For the professional forecasters, based on some of the conversation we had with some of them, first of all, they definitely understand theoretically long rate has these two components, but they build their model or build their statistical model that inevitably detect a very strong contemporaneous positive correlation between the long rate and short rate. So here's the key error. The key error really lies in their failure to program their model to distinguish between the expected component versus the unexpected component or unexpected changes in the interest rates, particularly the long-term interest rates. Without this, the model will exhibit some categorical thinking. So the models are really categorical. Well, for households, that story may be different because they may directly reason with categorical thinking, but also they may just follow some guidance or advice from people who suffer categorical thinking. For example, they just follow advice from the professional forecasters. But also, we're not claiming that everyone in the market is suffering the same kind of mistake. Categorical thinking may not extend to all professionals. For example, there's a specific group based on some of the preliminary evidence we had in the paper. Bond traders do not seem to price the long-term treasury futures in a way that's consistent with categorical thinking. So at least bond traders do understand this relationship very well. Okay, so for the final section, I wanted to really explore the relationship between this particular categorical thinking bias and some equilibrium market outcomes. So here we move from beliefs now to actions. So under categorical thinking, expectation of a rising short rate will naturally prompt borrowers like firms and households to rush to lock in a similarly low interest rate today because they anticipate mistakenly some higher interest rate in the future. This inevitably will lead to an increase in the short, at least in the short term, increase of the supply of long-term debt. On the other hand, from the demand side, investors will sell the long-term bonds because they anticipate a much lower price, much higher yield in the future. So the two combined can definitely essentially give rise to a lot of interesting dynamics. So we first look at the supply side, supply of long-term debt. So we look at the corporate long-term issuance. Particularly, we have four different measures focusing on the probability of issuance or the issuance normalized by balance sheet variables or the long-term issuance share as the total issuance. We find that predominantly there is a positive relationship between the actual issuance next quarter and also the forecasted change in the short rate. 1 percentage point expected increase in the Fed funds rate next quarter leads to about 10% increase in long-term debt issuance. And this is robust to controls for measures of uncertainty, such as the forecast dispersion of the short rate and also VIX. And second, you probably would expect intuitively this type of effect will be much stronger when the signal about the future trajectory of the short rate is more salient or better telegraphed, when the Fed tells people that now is the time we're going to do something different in the future. And this is exactly what we find. Focusing on the time when the Fed literally just changed from one regime to a different regime, the first time Fed hiked the rate or first time the Fed cuts the rate, the effect actually is 2 to 7 times stronger. We also have a similar evidence from the mortgage decisions using the aggregate mortgage data from FHFA. So here, particularly, we also include this interaction term between the expected short rate change and the Adami variable for the jumbo loan, essentially loans that are taken by wealthier individuals. We find that jumbo loan borrowers respond very strongly to forecasted changes in the short rate, consistent with categorical thinking, but importantly, also consistent with the evidence of a sophistication income that we have documented before. So finally, we move on to the demand side, looking at long-term mutual fund flows. So we're looking at particularly the flows into and out of the long-term bond mutual funds. And we find the opposite of the effect. That means 1% expected increase in the Fed funds rate for the next quarter leads to essentially a lot of money outflow from those long-term bond mutual funds. So mutual funds typically will experience significant 1 to 2% outflows of their AUMs. So finally, let me quickly comment on 2 implications that we're finding for the literature. The first one, as I have already talked about here, so categorical thinking, under categorical thinking, expected increase in the short rate will lead to an increase of the supply of long-term debt and also a decrease in the demand for long-term debt. The two combined can actually offer an explanation for the excess movement and a subsequent reversal in long rates. But also, perhaps more interestingly, categorical thinking can also have some specific implications for the forward guidance. So the post-2000 monetary policy landscape is well characterized by forward guidance and gradualism. However, forward guidance of an expected increase in the short rate has 2 opposing effects. The first effect is the conventional effect as intended by the Fed. A higher expected future short rate telegraphed to the public would lead to higher long rate today, which subsequently will reduce borrowing and credit extension. However, according to the evidence we find, there might be another opposing effect. That is, there may be a rush to borrow to lock in the long rate before the rate goes up further. Using the aggregate data from flow of funds, we find actually the channel 2 from categorical thinking seem to dominate, at least in the short run. Forward guidance of the Fed tightening leads to net increase, not decrease, in the long-term borrowing, at least in the short term, opposing what is the intended effect from the Fed. So this can also help, especially channel 2, can also help explain the forward guidance puzzle. That is why the forward guidance has been less effective than predicted by standard macro models. Okay, so let me conclude here. Thank you very much for your attention. So we have in this paper uncover and document this categorical thinking about interest rates. And categorical thinking can distort real behavior above and beyond the mistakes in beliefs. And the forward guidance and gradualism and monetary policy can be associated with perverse effects, and one of them directly coming from categorical thinking. And finally, to the literature of behavioral finance and behavioral economics, we find a very interesting case where accurate or relatively accurate belief about one variable, in this case the short rate, can lead to large forecast errors of a related variable, in this case the long rate. This significantly differs from behavioral research on beliefs, particularly those papers were focusing on persistence of the beliefs or shocks and how the beliefs misreact to new information. Okay, thank you very much for your attention. I look forward to Luigi's discussion.